In this video, I'm going to discuss the topic of imputed interest. And some of you may not understand what this relates to, but sometimes in accounting, even if an interest rate is not stated, or maybe somebody gets an interest rate that's below what they normally would get for for their risk profile, sometimes we have to actually impute or add on interest to what the market rate should be. And the idea of imputed interest relates to long-term liabilities, given that, if you recall, long-term liabilities are valued at their present value of future cash flows. So because of that, because you have that time value of money factor with long-term liabilities, if interest is not sufficient to parallel what market rate would be, then we have to actually add on some interest in there. You'll see in a minute what I mean by that. I'm going to explain the concept of imputed interest in the context of notes payable, given that it's similar to what we saw in a video on bonds payable, and except that with the notes payable, you're just dealing with a discount, right, to account for the interest. So this idea of having to impute interest, in my opinion, is kind of interesting. And when is it that you have to do this? Well, you have to impute interest whenever you have a scenario where there is no interest rate stated. So you might have seen some promotions in your everyday life where they might tell you that you can buy something and pay for it over the next 2-3 years with 0% interest. Well, if or no interest, they might say, right? And if that's the case, then even though the company itself said 0 interest or no interest, internally in their accounting system, they are imputing or computing an interest within the transaction. Okay. Same thing goes if you get a rate that is unreasonable for your risk profile. So in other words, normally you pay 12%, let's say, for a loan, and you go and buy a car, and this happens a lot with automobiles. You go to a dealer and they give you a 3% rate. Well, that 3% is unreasonable for your risk profile. So you, the consumer, might not know this, but behind the scenes, you're going to be so first of all, you're going to pay 3% interest, or what appears to be 3% interest. Behind the scenes, the dealer or the company doing the financing, they will compute that 3% as well, but they will also compute that added interest that will get them to the market rate that you fit in. So in other words, I said that you normally buy at 12%. Somebody's giving you a deal for 3%. Well, internally, the company will impute sort of the 9% additional that it remains. Now, the client, they don't know this, but we are within our company doing it. The other scenario where you might have to impute interest is when you have an amount of the note, the face amount of the note, that is very different from what the fair market value of that transaction may be. So that's one of those scenarios where you say, well, that amount is not reflective of what the fair market value is, so you would have to impute interest. So let me give you a couple examples here so you see more or less how this works. Here's the first one. On January 1st of X1, ABC Company purchased land by issuing a 5-year, 0 interest-bearing promissory note in the amount of $505. And ABC normally borrows at 11%. So notice what's happening here. Since we are in the topic of long-term liabilities, we're going to look at it from the perspective of the person borrowing the money. Okay? But you can also visualize it from the seller, right? The seller is going to also do this present value calculation. Even though I'm stating that I'm buying this land for $505 to be paid in 5 years with no interest, even though that's what I'm stating, from the perspective of a long-term liability, I have to get the present value of that 505. Sorry, this should be 505. 518. I have to get the present value of that $505,000 at the market rate. okay, in order for me to value the exchange. and it's just for 5 periods, right? So when I do that present value calculation, this should be around 300,000. Let's just kind of assume that's what it is. And which means that even though there's an amount of $505,000 being spoken, the true value of the exchange is that $300,000, which is the present value of those future cash flows. Okay, so naturally, when I record this transaction, I put the land at that fair market value. And notice how I record the note here for 505, but there's a discount to offset it by $205,000. So what does that mean? It means that technically I am recording that liability at $300,000 because these two go together. So that note payable, the carrying value of that note payable, it's still $300,000. It doesn't matter that you recorded this, maybe this wasn't the best way to put the bracket. Here we go. It doesn't matter that you recorded the gross amount right here and then you netted discount right to it. At the end of the day, these two go together, and a discount reduces the carrying value of that note. So given that, the value of this exchange and the amount of interest that I'm imputing is $205,000. So what does this mean? Okay, because we're in the topic of imputed interest. From my perspective, I bought land of $300,000. That's the basis of that land. Any other amounts above that, which are reflected here in the discount, are interest, related to interest, right? So this will be amortized over the next 5 years, and that discount will eventually go to expense, right? And what we're accomplishing there is we're separating what the true value of the land is versus the amount related to financing. Now, why do I find this interesting? As I say here, because, in the actual transaction, we're saying there's zero interest. That's what the deal is. But in reality, we need to impute that interest, whether it's stated or not. Okay? Second example. And by the way I figure out what the worth of the exchange is I get all the future cash flows and I do a present value calculation, and that's what gives me my value of the exchange. Let's look at a second example here. Same date, on 1/1/X1, ABC Company purchases equipment by issuing a 6% 8-year promissory note having a maturity value of $400,000. So notice the cash flows that are involved here. You have the $400,000 that's going to be received in 8 years. And on top of that, you have, based on what you stated on the note, you have $400,000 times 6%, and that's $24,000. Now, you got to be careful here because supposedly ABC borrows at 11%. So this rate of 6% would be considered unreasonable, right? Because your normal borrowing rate is 11%. And you're getting something at 6%. Well, we need to separate those components. And you need to lay out the future cash flows. So, these are your cash flows. You have a future $400,000 in 8 years. And you also have $24,000 per year based on what's stated. Okay? If you watch the long-term liability video, it may help you to remember that whenever we do any of these present value calculations, and I encourage you to go back and watch this video if you need to, we always compute the present value, listing out the cash flows based on what we say, the coupon rate or the stated rate, whatever the negotiated amount or percentage is, that's what we use to calculate the actual cash flows. But then we always do the discount and at the market or the real rate. So in the context of what we're talking about right here, this 24,000 is based on what we stated, right? That's how it's going to be. We're going to pay 24,000 every year, but the discounting itself occurs at the market rate or at the real rate that we borrow at normally. So without going into too much of the calculations, because you should be able to do this present value calculation, or watch that video so you can review it, the long-term liability video. I get the present value of the lump sum, and that's 173. That's at 11%, the real rate, the market rate. I also get the present value of the annuity of $24,000 at 11% for 8 periods. That's 123. So what this says is I'm buying this equipment with a promissory note of $400,000 and interest payments to be done. And what the worth of this exchange right now is $297,000 roughly. And that's very, very important, because you're not going to record. So here's that. Well, first of all, here's that transaction. So here's the equipment at the fair value of that transaction, of that exchange. Here's the 400,000 and the discount of 102, the difference. Again, this note, the carrying value is also 297, right? It's just that we're using that discount account to offset it. Very important that you do that. You could do the mistake. Some people might do the mistake of doing equipment 400,000 and then note payable 400,000. But you got to be careful with this, because this would be incorrect. This is incorrect because you would be overstating your assets. Okay, you do not want to do that. The asset itself has a basis of 297, not 400,000. And the note, the liability itself, is the net of these two, not 400,000 either. Okay, so just briefly, let me delete that before we even think of doing something like that. The idea of imputing interest is super important, because this equipment will be depreciated over its life, whatever that life may be, and the amount that is going to be used for the computation is 297, nothing more. On the other hand, this right here, this discount, is a different type of expense. This one here is depreciation. This one here is interest, right? And we got to not mix the two. One is dealing with assets that we use to generate revenue, and the other one is used for purposes of calculating interest on loans that we take out. All right. So naturally, you'd want to know, how do we amortize this? How do we deal with the interest when it comes due, right? So let's go ahead and do that. Let me show you here. So notice how I'm matching the colors. So if it's yellow here, it corresponds to that transaction, the first example. As in any expense or interest revenue computation, the formula is always this. You take the carrying value at the beginning of that period and you multiply times the market rate. So for example 1, the carrying value of that note is 505 minus 205, which is $300,000. You multiply that times 11% and you get an expense, an expense incurred of $33,000. You reduce the discount, and by reducing the discount, right, the carrying value of that note goes up for the next period. In other words, let me repeat that, because I think sometimes students get mixed up with that. Let me do a couple quick little T accounts right here. Bear with me, I'm sorry. All right, so here it is. So sometimes students get confused about this idea of the carrying value, so we got to be real clear here. When we started this, we had a note payable of 505. This is the yellow one, and that's what this was, 505. But with it, we had a discount of 205, right? So at the end of X1, at the beginning of X1, when we started this, the beginning of the period, right? At X1, the carrying value was 505 minus 205, which is $300,000, right? It happens to be the same as the land, of course, but that changes afterwards. Okay, so when I do this computation, I'm using this carrying value at the beginning of the period right here times 11%, and that's what gives me $33,000. Let's think about the next period, just to be clear. Now that I've amortized $33,000, that goes right here. the next period's balance in discount will affect the carrying value. So this will be equal to this minus this. That would be the carry. I'm sorry, I did that wrong. This would be this minus this, right? So in other words, the carrying value of this note at the beginning of the second period will be 505 minus 172. That'll be whatever it comes out to be. And that's what you use to calculate the interest in the second period times 11%. Okay, so remember, this is constantly changing. So here's a statement I made earlier. As you recognize some of that interest expense, okay, and listen to this carefully. As you recognize that interest expense, the discount is going down, right? The value of the discount is going down. And as the value of the discount goes down, it went from 205 to 172, the carrying value of the loan goes up. Because the carrying value in the next period, let me just do this real quick here. I should have done this before. Is going to be 505 minus 172, 518. And I'm not going to worry about what that number is. Let's call that number X, okay? What that means is for the second period in 1231X2, when I go to compute my expense, it's going to be whatever this value X is times 11%. Okay? All right, be very careful with that. All right, so the statement is, as the discount goes down, the carrying value of that note goes up because this X amount will be greater than 300. All right, so that clears that up. The next one, how do we do the interest for the second transaction? This one right here, the example number 2. Same thing, carrying value at the beginning of the period times the market rate. So the carrying value was a note payable of 400 minus 102 at the beginning. That gives me 297,077 times 11% gives me an expense of this. Now, once I have that expense, then I can plug the discount. And the reason I can plug that is because this cash is always going to be $24,000. It's what's stated. So 6% times 400 is the amount we stated as interest. So that's always going to be 24. So every time you pay interest, it's $24,000 no matter what happens to interest rates. So this discount is the amount that I'm going to amortize. Okay? And again, since I'm amortizing the discount, the value of the discount account goes down and the carrying value of the loan goes up for the next period. All right, that's the first thing. Now, without us saying much here, we were using the gross method to account for the note, right? Because we were using the note at its full future value at the face amount minus the discount. You have learned as well that you can apply the net method. You can do this using the net method without necessarily changing anything. So just for the heck of it, let's kind of see what happens if we do use the net method here. I think it's worth visualizing this. So if you decide to use the net method using the same information, so this is all the same information, keep that in mind. If I use the net method, that the land still goes in the books at 300, but notice how I put the note at 300, not using the discount. These two things, for all practical purposes, are the same thing, okay? Because this is telling me that the carrying value of that note is 300. This is also telling me that the carrying value of that note is 300. So it doesn't change anything. For this example number 2, same thing. If I use the net method, I'm just going to put the note at the net amount instead of having the discount in there. And it makes no difference. So some companies will choose to use the net method approach here, or some companies prefer to use the gross method approach, right? Detailing everything. It makes no difference, and it's the same thing accounting-wise. Now, for me, and it's preference. For me, I prefer to have this discount in there, simply because then I can track it more easily, as opposed to having myself not see what the discount amount is. But truly, it doesn't make a difference, because when you go and compute interest expense, the interest expense is still the same computation. Carrying value at the beginning of the period, okay, so that's 300,000 times 11% gives you $33,000. Now here's the difference. You debit expense, interest expense, but instead of going to a discount account, you're going directly to the liability note payable. And that is directly increasing the carrying value. Okay, so for the next period, the carrying value of that loan is going to be $333,000, which, by the way, we didn't do this computation here, but this should be $333,000. That's the carrying value for the second period. Hopefully that works out right. Okay. So in other words, if you're using the gross method, you're going to have to offset the discount. If you're using the net method, you go directly to the note itself. Same thing here for the second one, the second example, the blue one. The expense is still the same. That doesn't change. The payment to cash, that's still the same. But instead of taking that amortization amount to discount, I'm taking it directly to note payable, and hence increasing the carrying value of that note payable. All right. So hopefully this was an interesting video to you. I always think imputing interest is quite interesting, because it's one thing what we say to clients, or it's one thing what the actual negotiations dictate, and it's another what reality is. Reality here is that ABC, no matter what, pays 11%. So whether I say that I'm paying 0 or not, I'm still going to compute this transaction based on a discount rate of 11%. Here, I'm saying, hey, I'm paying 6%. That's based on the transaction negotiations you did. But when you actually value that loan, you need to discount it again at 11%, the real rate. And you may wonder why these things occur, right? Well, from a business perspective, sometimes companies issue these promotional things, zero interest bearing notes or interest that's lower than the reasonable amount, as a marketing approach. Okay, it'll get people to come in and say, well, you know, the interest is low, so I'm going to get a better deal. And that may be the case or may not be the case, depending on what happens. But I want you to think about this. A company has to make money, right? So if you lend money for 5 years, okay, somebody's lending us money to buy this land for 5 years. From a business perspective, I have to sell this land at a high enough number to make money. So when you have zero interest bearing notes or something like that, you could argue from a business perspective that you might have to charge a little bit more for the product in order to make up for that supposedly interest that you're not charging. So the moral of this story here is, in business, we see things like this all the time, where you're stating interest rates that are just not the reasonable amounts, or you're telling somebody that they have to pay a face amount that's much less than what the real value is. And for those kind of things, we have to impute interest like we illustrated right here. All right, hopefully that helps. Well, one last thing I will say. So this was 0% interest, right? But reality is 11. This discount amount, it's kind of like the 11%. And that's kind of clear there. Look at this one. This one, it's 6%, right? So when you do 6%, it's $24,000 you're paying, and that's part of this interest expense amount. Whereas the additional amortization right here, the additional amortization, that relates to that difference in interest that you really have to pay. In other words, you pay 11 and they're saying it's 6, so it's kind of like accounting for that 5% difference, if you can see it that way. Here, this would be like the 5% difference that's going on. All right, this concludes the video on imputed interest on long-term liabilities.